What is a qualifying widow or widower to file for your taxes? So after I talked about Mary yesterday, whose husband died in July, a number of you, some of you guys even emailed me saying, hey, she could qualify, she could be a qualifying widow as opposed to a single taxpayer. And the answer is no, she can't. So I'll show you what it is. She has this year and this year only to be married filing jointly. Next year she has to be single, and that's just a fact. There's no qualifying widower or widow that is applicable here. So let's go into what that is actually. Check this out. And this is from Investopedia, and its IRS documents the same thing. Qualifying widower or widower refers to a tax filing status that allows a surviving spouse, Mary, to use the married filing jointly tax rates on an individual return. The provision is good for up to 2 years following the death of the individual spouse. The taxpayer must remain unmarried for 2 years following the death of their spouse in order to qualify for status. All right. So in that case, you're like, hey, well, she's not married. She hasn't got married again, so she could file basically married filing joint for the next 2 years after this tax year, because this tax year she can still file married filing joint. But that's not true. What is it? Qualified widowers is a tax filing status that allows it. We already talked about it. The surviving spouse must remain unmarried. We already talked about that. The taxpayer must have at least one dependent child and have handled at least half of the household cost. All right, so to be a qualified widow or widower, you have to have dependent children. And in this case, she doesn't. The qualified widower status offers the same standard deduction amount and tax bracket ranges as those for married couples who file it jointly. The surviving spouse must file as single or a head of household in the 3rd year after a spouse's death. So again, this is not applicable here to marry, because a qualifying widow or widower, you must have dependent children, at least one, and Mary doesn't. She has no kids. So in this case, she has to file. She'll file this year as married filing jointly, and next year she's got to be a single taxpayer. So we're coming up against it in terms of the clock to take advantage of the married filing jointly rules as opposed to single taxpayer rules. Because watch, there's a significant difference, guys. Watch this. Here's the standard deduction 2023 for single taxpayers, basically $14,000. Here it is for married filing jointly, $28,000. All right, that's just a standard deduction. We're going to show you the actual tax rates too. The $13,000 standard deduction, and this is your taxable income, to be at the top of the 12% tax bracket as a single, you have $57,000. With the $27,000 standard deduction for married filing jointly, to be at the top of the 12% tax brackets, what's that? About $120,000. So pretty significant difference there. So in this case, Mary in 2023, she could basically get $120,000 out of her IRA taxed at the top of the 12% tax bracket. Not taxed at 12%, because we still have the first standard deduction of $27,000. You know what I'm saying? Plus, we get the first there's a 10% tax bracket, a 12% tax rate. So effective tax rate probably about 11% or so. But that's the difference here. $89,000 of income this year puts her in the 12% tax bracket. That's taxable income, by the way, after standard deduction is taken out. $89,000 next year puts her at the top of the 22% tax bracket. That's a significant difference from 12 to 22. So you got to know how to take advantage of the tax code in the year of your spouse's death. This is it. This is the last time she can use married filing jointly unless she gets married again. So we got to take advantage of it. So just remember, qualifying widow or widower is not applicable to many people because most of the times they're not going to be dependent children anymore. All right. Love your thoughts. We'll see you